Yes, last but not least on the agenda, capital allocation. And let's first look at the total shareholder returns, because if you look at that, we have unlocked significant value since 2017. 102%, of which 58% through the appreciation of the share price, and on top of that, of course, the regular dividends and special returns to shareholders. And we are delivering on our capital allocation priorities, and we are delivering consistently on those priorities. And maybe it's important to repeat it again. We are investing in organic profitable growth with roughly 3% Capex. We have a dividend policy, stable to rising. We are executing on our bolt-on acquisition strategy and make sure that they are value creative. And we do share buybacks, and that all in a framework of a leverage ratio between 1 and 2 and retaining a strong investment credit rating. Now, Thierry talked about it already. We are on the way to our 2 billion adjusted EBITDA target. And it's good to take us back to 2018. At the time, we were at 1 billion, and meanwhile, we have made a step to 1.4 billion. But the 1.4 billion in 2021 was in extreme difficult circumstances and in pretty volatile circumstances from a supply chain perspective, but also from a raw material perspective, with a headwind of 770 million euro in terms of raw material price inflation. And in that context, we still realized an adjusted EBITDA of 1.4 billion in 21. And as said, with the adjusted EBITDA bridge, which we have shared with you on the growth side as well as the deliver side, we are confident in realizing the 2 billion by 2023. It's also good to mention how we have progressed from a return on investment perspective. Coming from 12.6% in 2018, we have now improved to 16% return on investment. Let's now talk about working capital and free cash flow. Because if we compare ourselves to comparable peers, our working capital performance is lower compared to these peers. And it's important to mention that during 21, the raw material inflation had a significant impact on our working capital. In fact, if we just correct for the raw material price inflation, that impact is roughly 2%. So from the 9.9% where we ended in 2020, 2% is due to the raw material price inflation, and that obviously has also impacted the free cash flow delivery in 2021. But overall, over the past years, we have made incremental improvements in terms of our accounts receivable and specifically focused on our overdues, as well as incremental improvements in terms of our payables. And as you heard Karen Marie talking earlier, we are now very much focused on our inventory levels, and with the supply chain initiatives and also with the product management initiatives, we see an opportunity to decrease our days inventories with 20% versus where we are in 21, and that 20% is by the end of 23. So overall, I like to stress and reiterate that this business is a highly cash generative business given the relatively low Capex intensity. And talking about Capex, here you see the development of our capital expenditures from 2018 onwards. And in fact, step by step, we have been investing more in the business and in growth, leading to a Capex level of 288 million by 21, which is roughly 3% of revenues. And you heard Karen Marie talking that we have shifted in terms of Capex from maintenance to growth. But also, if you look at a regional level, you see that we are investing more and more in the Asian region, from 27% of the total Capex in 2018 to 33% by 21. And that is, of course, driven by investments in our powder business, but also driven by investments in our large-scale plants in the regions, which then cover the multiple products for multiple business units. And now talking about shareholder returns. Yes, we have post the chemical divestments, we have returned 2.5 billion. But if we take since the end of 2019 till early this year, we have deployed 1.8 billion in share buybacks. And that has resulted in a 29% reductions in terms of our shares, from 256 million to 182 million. And with the recently announced share buyback of another 500 million, which we will execute till the beginning of next year, at current share price, the number of shares will go down to 172 million shares. Dividends, we have been executing on our dividend policy, which is stable to rising, and it has delivered a 2.3% dividend yield over the past years. But maybe more significant is the adjusted earnings per share growth of 113% over the period 2018 to 2021. Of course, on the back of our earnings growth, but also on the back of the significant lower share count. And that brings indeed together the execution on our capital allocation priorities. Because some of you might remember that back in 2018, we had quite a number of discussions on the low leverage ratio of the company. And at that time we said we will lever up, and we have used a target leverage ratio of between 1 and 2. At the end of 21, we were sitting at a leverage ratio of 1.6. And if we look at our cash deployment over 2020, 2021, roughly 75% of the cash deployment has been to shareholder returns, and the remainder in Capex and in M&A. And talking about M&A, we have been executing on our bolt-on acquisition strategy and done that in a very much a value accretive way. And here you see on the left of the slide, you see the whole list of bolt-on acquisitions in the period 2018 till now. And we will see this quarter Orbis becoming part of the Akzo family. And you might well know that we do this all to make our business better. So we have mapped our total portfolio, and we have created a pipeline to improve the business from a geographic perspective, from a product perspective, and from a technology perspective. These acquisitions over the past years have delivered a 1% CAGR inorganic top-line growth. And if we look at the value creation part of these acquisitions, then the value-weighted multiple after synergies sits below 11.5, so below our own multiple. But it's maybe much better to just go to an example of an M&A case. And let's therefore go to Spain, the decorative paints business in Spain. Because when we looked at the decorative paints business in Spain early 2018, it was a small business with a small market share with a single-digit return on sales. Over the past years, we have created a strong and a leading position in the Spanish market with our deco business. On the back of the Xilazell acquisition and more recently, the Titan acquisition. And currently, we are well positioned with 3 leading brands, including the Bruguière brand, with a very strong distribution network, a very strong commercial team, leveraging the platform which we had already in Spain. And that has delivered the synergies, and in fact, half of the synergies for the Titan acquisition will be delivered in 22, and the remainder part post 22 in 2023. But maybe I can talk about it, but it's much better if I asked the leader in Spain to talk about it. So let's go to the video and let's ask Michelangelo to talk about Spain and what he has done there.
Well, first of all, I feel very proud to lead what we can really call a transformation in Iberia. After 1 year of activity as one company, we have the first result, and I can confirm that we have an upside versus our acquisition business case of about 5% in top line sales revenues and of about 3.4 million in EBITDA. Customers essentially recognized our leading role in Iberia, and even more important, they recognized the value we can provide them as one combined company in the market. After the acquisition, we represent more than the 20% of the full market, 3 times the size of the second competitor in a very fragmented market with 300 local producers. It really means that we lead in size and performance, and we can leverage on our local and global scales. One of the main drivers of our performance is sustainability and the focus we have on sustainable products, both under a customer as well as a legislative perspective. I lead also the Italian decorative paint market, and last year we had a substantial growth in exterior wall paints by 70%. There are some countries where we expect similar dynamics happen taking place in the future. With this acquisition and with this focus on sustainable products, I can see for 2022 and also for the following years even an acceleration in the speed. And finally, with our one team, one dream mindset, it is really impossible not to be confident in the future.
And thank you very much, Maarten. You've joined me meanwhile here at the table. Maarten, we've heard from other speakers that the Liver initiative can lead to improvement in inventory. Given these initiatives and also inflation to hopefully stabilize, what can we expect in terms of working capital by 2023?
Yeah, from a working capital perspective, the focus is really on the inventories, and we see quite some improvement opportunities given the initiatives in the end-to-end supply chain, but also the initiatives in product management. So from that perspective, I only like to reiterate what Cara Marie said, that we focus on an improvement of 20% in terms of inventory days. And meanwhile, we will continue our incremental improvements from a receivable perspective, and it's mainly overdues as well as payable perspective. So yes, there are still opportunities from a working capital perspective. Yeah.
Okay. For M&A, there's been more paints acquisitions than there have been coatings acquisitions. Is that something we can expect to move the same going forward?
Yeah, indeed, we have seen a little bit more paints acquisitions. But if I do a step back, we have a very healthy pipeline in terms of possible targets we are looking at. We have mapped those against our portfolio. And finally, it is more the availability of the targets, because most of those companies are privately held. And then it is more a matter of timing and when the target will become available. Good that we've seen more more activity in the M&A markets. So it's not that we have a stronger preference for deco versus coatings targets. It's more the timing and the availability.
Right. I look forward to also seeing you at the Q&A, Maarten, together with all the other speakers that presented today. This brings us at the end of the presentation part, but I would now like to invite back Thierry, who will do a recap of everything that we've heard this afternoon.
So, as they say, time flies when you're having fun. And that not only applies to this 2.5-hour presentation, maybe fun for us, maybe less for you in front of a screen, but we hope you enjoyed it. But time flies when you're having fun, also in respect on the journey that the company did since 2018. The somewhat lazy, self-complaining teenager in the couch I was describing in 2018, great ideas but very little action. If you look at what we did over in 15 by 20, we brought the company by 2020 really on what we promised to be on par with our competitors and with our best competitors. We did that through really relooking at our cost, by really looking at the mandates by business on where we could win or where we had to make big changes, by really looking at our processes and putting the systems in place to get where we needed to go. And we also were very disciplined on our capital allocation, and we assume a pretty shareholder-friendly capital allocation. Despite everything that happened in 2020, despite everything that happened in 2021, we stayed on course. And in fact, in the fourth quarter of 2022, we were above what our US peers were delivering as a collective group. With all the pricing work we did, with having a high engagement in the organization and a clear purpose and North Star on where we want to go with the business and strong franchises around the world, we feel we're extremely good position to really now in 22 and 23 deliver on our promise to bring 2 billion euro EBITDA to the bottom line, and by growing faster than the markets that we operate in. And that makes us, as we believe, an attractive case for an investor. Our multiples that we have are still significantly below where others, specifically our US peers, are sitting. We are performing at the same level, and we feel we have the right dynamic, the tailwind going into the next period. And in fact, it's not a surprise, therefore, that we feel, in case of any doubt, that for us to invest in our own shares is probably the best place where we can put our money. What we did in this 2.5-hour journey is showing you the elements that we're busily working on to get us from this 1.44 billion EBITDA that we delivered in a very tough year in 2021 to get us to this 2 billion target that we have for 2023. What you saw is an element that comes from growth. Growth driven by market growth as such. And what we indicated is that the number that is out there that is given by Orr & Boss, which is probably the most reliable firm out there in the past, has been pretty credible on what their market forecast was. They come up with 8% volume and revenue together, an 8% growth, close to what our own numbers would say, but we took a 2% haircut on that. So we took a 25% haircut to make sure that our business case to get to the 2 billion is still in place. We do that by continuing to build our franchises, but also to keep investing in the growth in those elements of our portfolio where we're clearly leading and where we see the markets coming back again. At the same time, it's probably fair to say that we've been extremely disciplined on our margin management over the last years, and that will continue to be the case. We've really worked hard to get on top of that wave of raw material inflation, and that is really, as has been in the past, an opportunity to do a very nice margin expansion. So that's on the growth element. The second element, where we had to take you deep under the hood of the car of a paint maker, is really around using now the information, the capabilities and the processes we build up to really get product management as an enabler to drive all the things we wanted to do in our end-to-end supply chain. Many people are working on that, many things are delivering, and frankly, we think that this is a very credible case for delivering 200 million to the bottom line. With that, we feel good where we are. We feel we have the momentum. We feel we're going to deliver 2 billion EBITDA. We have a habit of really making sure that we keep our promises. And in fact, with that, we not only want to be a reference in our market, but we really want to start getting to that point of being a front runner in our industry. People, planet, paint being the one that propels us on for delivering in 2023 and way more in the tank beyond that. Thank you for watching.